You just sold a stock and you made a profit. Let's go. But do you got to pay taxes on that? What's up, everybody? Chris Lee, Everyday Finance 101, Masters in Finance, CPA, personal finance enthusiast, talking to you today about capital gains rates and how much tax you got to pay on those investment gains. So there is short or long-term capital gains in the United States. Now, this is not for a Roth IRA or 401ks. This is just traditional brokerage accounts, okay? Short-term capital gains, that is when you hold an asset for less than 1 year. Long-term is 1 year or more, and yes, you are taxed differently based on how long you hold the asset for. If you've never seen the federal tax brackets in the US, this is what they look like for a single person in 2025. The reason I'm showing you this is because for a short-term capital gain, you have to add that gain to your ordinary income. So in the example we're gonna do here, I'm gonna have the person making $75,000 of taxable income. So they are gonna pay a 22% tax on their short-term capital gain. The long-term capital gain brackets are their own beast. And so you can see they are only taxed at 0, 15, or 20% depending on how much money you make. Again, same example, $75,000 taxable income for the single person, they are going to pay 15% taxes on their long-term capital gain. So 7% less than the short term. In this case study, we are going to assume that a single person has $75,000 in taxable income, okay? So for their short-term capital gain of $1,000, they'd have to pay 22% tax, leaving them with $780. Long term, they held it for more than a year, that $1,000 is only taxed at 15%, leaving them with $850. How long you hold an investment, short-term or long-term, matters as far as how much tax you're gonna pay, short-term versus long-term capital gains rates. The example we looked at today, it was a 7% difference, which matters to people, and I want you to understand that. Hopefully this was helpful. Chris Lee, Everyday Finance, and I will see you in the next one.